off the after taking out London's low, Asia's low, and then I'm looking for that inversion. Normally, I'm using the 5 minute for my inversions because, like, as the price has been so volatile lately, it's like a better confirmation for me to get that 5 minute inversion after the liquidity sweep. But I was watching the stream today that Michael had, and what I had noticed is basically like the real time trading hours, that high and low of the gap, like, because in longs today, I took longs at 9:52 a.m. and I'm targeting London's high today, and I made like 15K profit on that because I'm trading with a pretty decent large size. And then we reversed right off of that. What was that? That real time trading hours gap high.
Regular
And
trading
what
hours.
Yeah,
Regular trading.
regular trading hours. I
re-
love that. He's the RTH, real
my
time,
mistake. Yeah,
regular.
yeah, yeah.
High five, buddy. It's all good. I mean,
Regular.
it's nice to flex how much money you make, but it's even a stronger flex to know what the R stands for. Go ahead.
You right. You right. Regular trading hours. And we reverse wrap that regular trading hours high. Uh, but I'm looking at that, and I went back testing a little bit, and I'm seeing how that's actually a great level to use for like a model 2022 type of, for the liquidity sweep. And that's like what I kind of got today from the live stream. I was also trading at the same time, so I didn't. It was like, it was kind of maybe I wasn't. I don't know if that's the correct assumption, but is that a valid level to use as the liquidity sweep to look for, that level to be swept and then the inversion? Uh, because like right now I'm using previous daily lows, highs. I'm using the session highs and lows. Should I also be looking at that real time trading hours high and low as a level for the liquidity sweep?
Well, the regular
Um,
trading hours.
and then an
Oh, I
inversion.
thought you were done. I'm sorry.
No, no, no. I am done. Yep,
The
you're good.
regular trading hours gap from last Wednesday, we didn't explore that until overnight, last night, and this morning. So because it was left open over the last week, normally I've already counseled all of you to have your opening range gaps, keep them on a chart, some kind of workspace. Me, I'm old school. It's literally on a notepad, and it's me going back over the last 5, sometimes 7 trading days, and I'll look at where certain opening range gaps don't have the full delivery, both sides. In other words, if we created an opening range gap, if it never fills in at all, it just creates it and just drops away or rallies away from it. That's a level it's going to come back to. It's going to come back to it. And it may take weeks to get to it, but I am absolutely interested in it. Should we start gravitating towards it? Because it's going to be one of those moves that just is like a black hole. It just pulls it in like an event horizon. That was why it was salient today, because it hadn't been traded to at all. It formed, but did not get utilized at all since the 4th of last week. So every opening range gap, regular trading hours, opening range gaps, whether they get filled in completely, back and forth, price action delivered, rebound, and then trade away up above or below it, even though they've been utilized, we do not discard them. So they are you could trade a model just on that. Trade one relative equal high or relative equal low to the closest opening range gap, high or low, whatever the level is, it's closest to what you think in terms of your bias. That's your model.
Drills. Ding, 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 ding. Community. I just heard gap theory, relative
Yep.
equal highs, liquidity paradigm, gap theory,
Yep.
classroom assignment.
All you have to do is have something that's going to cause you, like, what makes the market go up or down? It's liquidity or inefficiency. That's the only 2 reasons. I don't care what anybody says. It doesn't matter how many people are buying and selling. It's going up to a level to balance an inefficiency, or it's going up to engage liquidity, to bring lifeblood into the marketplace. So if it's going up for either one of those 2 reasons, where can you key off a long entry? If you go back over the last 5 days, chances are very high that you're going to get a revisit of an opening range gap high or low, or its consequent encroachment. There's 3 levels to look at. And if it trades down into it, you can expect it to repel off of that. And the only thing you're looking at is relative equal highs and relative equal lows for the price action side. But behind those candlesticks, there may be a level like an opening range gap. And if it coexists with it, you have now one of the largest draws on liquidity that makes it easy. You can feel real confident it's going to go there. Then just simply look at any fair value gap that forms that you can frame a good risk model around. Don't over leverage it. Get in sync with that move, and then capitalize on it and close your charts and be done for the day.
Right. Right. And what you're basically explaining today is how you should be looking at the 15-second and the 5-second for that entry model, that 15-second
What did
inversion
you
or
get?
something like
What
that.
did you get from that? The
After
portion I talked about with the 5-second and 15-second. What specifically am I showcasing in today's live stream that you took away from it?
that I took away from it was that I mean, it's just still very chartable, and you can have a nice tight stop in these conditions, which is to me what's hard right now because you can see that like obviously that the nearest swing low or I know how you talk about how the candle, the first candle of the fair value gap, obviously three candle pattern, the first candle should be where your stop is, and if you're doing it on the 15-second, it allows you to afford to take more risk uh and not not lose your shirt
More risk. That's what he said,
and
Michael.
then
He said more risk.
well not more risk, I would say the same level of risk but just with a tighter stop, right? Because if you're putting on your contract size and then using a like I use the 5-minute chart, and so I'm having to use like the first candle of the 5-minute gap that the first, so obviously my stop's gonna be a lot wider, I have to size down, whereas if I'm using a 15-second for the entry model, it allows me to tighten up my stop so I can use the same if not more
So,
size and then
so
be wrong but not
Trader Adam,
lose.
quickly, and Michael, can we circle around to a few speakers to answer your question? And respectfully, Trader Adam, will utilize your answer in conjunction with a few other folks' answers just to get a little bit more feedback. The
Sure.
question has been,
Sure.
what did you take from the 15-second, 5-second lecture part or piece? Correct, Michael? Would you like to re-engage the question, and we'll re-engage the audience to try and get a little better feedback for your question as we're wrapping up here in the last few
Sure.
minutes of Trader Roundup?
The question I have as the presenter of that stream today was what, because I may not have done a good job. What I think I've done today may not have actually hit the mark I was aiming for. So if I can get feedback in regards to what you as a viewer of the stream, what did you take away from me even mentioning the 5-second and 15-second chart in relationship to the 1-minute chart?
Okay, prerequisite. You have a speaker tag and you watched the lecture. Matthew, you're up.
Oh, hello, can you hear me?
Yes, sir.
What's going on?
Not much, brother.
Just want to say thank you for having me on. Thank you for Michael for everything you've taught us. In regards to the question, uh, for the lower time frames, it was from what I got of it, it was just measuring the strength of the fair value gap on the lower time frame fractals on the 15 and 5. Um, Measuring if it goes if the bodies close above the consequent encroachment of it.
Okay, I'd like this to be kind of quick. I appreciate the answer. If you've got a speaker tag, just pick up. This is a conversation. All right. Again, Trader Adam, Matthew, thank you. I'm trying to get quick response here so we can have Michael close the stream, and you providing feedback's important. Burt Trades, I know you got value, brother. Bring it, bring it.
Can you hear me all right?
Yes, sir.
All right. So what I got from it at the end was you can go to these lower time frames, such as the 15-second, the 5-second, and PD arrays you might not see on the higher time frame. 1, 2, 3, 5. They'll show on those lower time frames. Is what I got from it. Sorry if I'm out of breath.
Hey, bro, I appreciate it. That's what you got. That's what Michael wants to hear is feedback on the lecture and how he delivers it. Keeping it going, keeping it flowing. Ryan, I got
Can I say what I
Mauricio
took away from it?
Gertie. Pardon?
Can I say what I took away from it?
Yes, sir, you can.
So personally, if you look on the 5 and 15 seconds, still using like the 1 and 5 minute PD arrays, even the bodies on the lower time frames are still respecting the quadrants. So that's just showing the algorithm is working. That's what I took away from it.
And I would say maybe who's also what I got from it was like, you have multiple opportunities to enter, like, for example, if we did invert a 5 minute for value gap after the liquidity sweep, the 15-second will offer you, many more entry opportunities, obviously. So obviously, yeah, don't chase the move. And as well, yeah, it offers you a tighter stop. So you can afford to be wrong more, because what I found with the 15-second is, of course, you can get stopped up more often, but it doesn't necessarily matter, because obviously, as long as your stop's tight, your risk is set in. You can afford to be wrong a couple times, and then, and still lose a lot less money than if you were just banking on that bigger stop
Beautiful.
loss.
Well said. Noted. We're
Um,
on time. We're on a time constraint here. I'm going to keep it going. Going
yep,
to leave
yep.
the last few minutes for Michael to close. Gertie, I'm cycling through some speaker tags here, folks. Hopefully, you just jump in, can be conversational, answer the question, and we can keep it going. This is awesome. Gertie, you're up
Quickly,
next. What? Oh, I'm sorry, David. Pretty please jump in, of course.
yes, quickly. Just for those that still doubt about the macros, like look at a Nasdaq right now, or like today, basically. Look at when the lows of the day has formed, and look at where the high of the day has formed. Okay, and maybe you can type in the comments what do you see. Right, that's it. That's all I want to say.
I love it. I love it. Gertie, you're up next. 15 and 5 second chart. What did you get from it from today's lecture?
Hello, everyone. My bad because I joined very late, so I didn't hear the full conversation. I just want to thank Michael for everything he's doing for free for everyone, because not a lot of people appreciate him. But yeah, I didn't hear the full conversation, so I can't give a take on that. But
Okay,
thank
that's
you,
okay.
Michael, and
That's
thank you
okay.
for having me here.
Appreciate you. Ty, you're up, Ty.
Hi, thank you guys. So what I got from it was in the smaller time frames, we have these fractals, right? So like we have the sell side and we have the buy side. So we can take on less risk by scalping, identifying that range and then taking those like 20, 40 pip trades. That's kind of what I got from it, so that you're not in this, maybe 10, 15, 20-minute trade when the market is almost rugging us all, right? So that was my take.
Ooh, I love that being the final note from the student and Michael. The floor's yours in trying to wrap up per our time frame here.
Well, thank you for that feedback. Some of the things made its way to the target, but there was this major thing I have in mind that I was trying to communicate, and I'm convinced I didn't do a good enough job. So let me say it here, and then I'll demonstrate it in review tonight. I probably won't get the video up until around 8 o'clock my time, but it'll be up before I go to bed. But the idea of if you know where the draw on liquidity is, okay, if you have a bias, if you think that the market is strongly favored to go lower to a particular level, whether it be a single low or relative equal lows that have some kind of support around it, not support like support and just, but some kind of support in confluences, other things like a higher time frame opening range gap. It could be a new week opening gap. It could be a new day opening gap, something that's also in that same proximity. And if it can occur in the last 5 days, you have what we considered a very, very strong likelihood, because high frequency trading algorithms run on data that is compiled many times, not just on today's data and yesterday's data, but over the last week. So they get an envelope of high range value and low range value. And in deference to where that range is, they will use fixed ranges of inefficiency, or in this case, liquidity. So by having this understood, when we look at a 1 minute chart, and this is, say, for instance, you believed that the market was going to go up to 25,440 because you learned what it is I taught. I told you to keep your eye on that May 4th regular trading hours opening range gap, the high and the low of it. Having those levels, it basically formed so far today's intraday high. And knowing that the 1 minute would eventually traverse up there, if you see a move originate on the 1 minute chart and now the buy program begins. It's about starting to move higher. Now you have bullish order flow. The benefit is now you can go down into the 15-second and anticipate fair value gaps that form as a buy side imbalance, sell side inefficiency. That means it's going to be an up close candle on the 15-second chart. It's going to be its single pass, one little isolated candle, and then you can anticipate the next candle that forms over the next 15 seconds. You're going to see that form the third candle and then leave a portion of that buy side imbalance, sell side inefficiency open. When it stays open, it's confirming to you that order flow is still bullish. You can use that as an entry. You can use it for stop loss management. And then going down to the 5-second, the same thing. But you're going to see porous price action reflected in these lower time frames. On the 1-minute chart, if you look at what we've done since 10 o'clock to 12 o'clock noon Eastern time, the market did in fact drop, but look how much it went back and forth in the range that was created as it dropped. It kept going back and forth, but still steady dropping. That's high resistance. We don't want to trade in those environments. You can. I have students that's done it, but it's like running a marathon with somebody on your back. It's very, very difficult, and it spends a lot of mental capital. When we see porous price action on the 15-second and the 5-second in support of, in the direction of, in the order flow run towards the liquidity that we've identified as the draw on that 1-minute chart, the 15 and 5-second are confirming order flow is in fact clean, bullish, it's staying intact, because the 1-minute chart may have, for instance, look at the run from 9:48 up to the 10 o'clock 10:10 high. There's lots of inefficiencies that open on the 1-minute chart. But inside those inefficiencies that remained open, study it on the 15-second and 5-second chart. And you'll see that the signatures are still there supporting that. Yep, everything's still indicating it's bullish, even though we don't need that 1 minute to reflect it. Because if it's in low resistance, what do we really want to say? We want to say we're part of a run that the market's just ripping in our direction. We don't want to see a lot of give and take. We want to just, it's in a hurry to get there, which is why I teach you to look for low resistance liquidity run conditions where the market is in a fast paced hurry to get to your target, not because it's your target, because that's where it's going. By having a view and a constant reflection of the 15-second and the 5-second chart, not only are you able to manage risk appropriately, but it also affords you opportunities for you to go into pyramid and build your position up larger. Not that that's something you should strive for in the beginning, but over time, when you get better at knowing what you're doing, moving from one contract to two, you can use this approach to using the lower time frames to afford your new entries. And in stop management, you want to keep 3 PD arrays above your stop when you're long, and you want to keep 3 PD arrays below your stop when you're short. Because after 3 of them giving up the ghost on the lower time frames, it's going to make a run on that 1-minute chart, which is what you anchored your trade on anyway. So order flow is determined by 1 minute. The micro market structure and the PD arrays that form on the 15-second and the 5-second support the underlying thesis that 1-minute charts running to that draw and liquidity you anticipated being the draw. You can take new position entries. You can manage your stop. But the key takeaway is it's telling you visually that order flow is bullish. There's no necessity for having level 2 data, footprint, none of that stuff. You don't need to see any of that stuff, because if a market's bullish, it'll leave buy side and sell side efficiencies left open and not completely closed in. And every time it makes new higher highs on these lower time frames, and it's making no attempt to get back in and do patchwork, that's going into those gaps. If it has no interest in going into them, what's it signifying? It's co-signing that it's absolutely in a hurry to get somewhere. Otherwise, it would go down there and fill in those inefficiencies. It has no interest in anybody who wants to buy down there. They don't care. They're getting the middle finger. See you later. Catch you next time. I'm out of here. And they're leaving, like Elvis left the building. That's what you want on your trades. You want to see those signatures. If you see that, it supports confidence. It tells you to hold on to your trade. Don't lose confidence. Just hold on to it. Submit to the length of time it's going to require until it gets to your target. That was what I was aiming for. So if you didn't get it from the live stream, hopefully you got it now.
Bang.
That definitely makes sense. I appreciate that.
Bang. Speed, velocity. directional momentum